All right, stay with me, Tom. Let's expand the conversation. Bring in Schwab's Kevin Gordon, along with CNBC contributor Capital Area Planning Group's Malcolm Ethridge. It's good to have you both with us. Kevin, I'll hit you first because you're here. Now what? After last week, we shook out some stuff.
Yeah.
Now what?
I actually think, part of the relief that we're feeling today, in addition to the shutdown, is actually related to some of the compression last week that you saw in the high flyers, whether you think of it as the Mag 7 or, the hyperscalers within the S&P, and then a relative catch-up.
Jim Leventhal was making that argument on halftime, and I was somewhat skeptical of that. Well, now Tom Lee's bringing it up, and so are you?
Well, I think that, but the positive aspect of this broader, and if you extend it out maybe the past month or the past 2 months, we've been in this broader consolidation, if you want to think about it that way, for the market. What has gotten hit the hardest have been the more highly speculative, non-profitable parts of the market, which have completely outperformed. I'm talking triple-digit percentage points since the April 8th lows. They've definitely outperformed year to date, but they've been the ones that have been shouldering a lot of the blame and have been taking a lot of the hits, especially relative to what we think of as traditional markets like the S&P 500. So I think that when you look at what's been concentrated in terms of selling pressure, actually the overlay to 2021 is pretty similar, where the broader indexes are still doing relatively well. It's just more of the speculative and junkier parts of the market that have been getting hit a lot more. Which admittedly they've had solid runs, but I think that's all else equal a healthier setup because the market is still favoring quality and having a bias towards that.
Malcolm, do you think that the financial mechanics, so to speak, of the shutdown played a bigger role last week than some are willing to admit?
I do not. It probably won't surprise you that I have a little bit more of a contrarian take on this, but I really think this is completely attributable to Sam Altman's comments to Brad Gerstner. I think it's attributable to Sarah Fry's comments about a backstop from the federal government, comments about maybe we won't see an IPO in 2026. I think that investors have been paying very close attention to what OpenAI is doing, even though it's a private company, and extrapolating out how much of the growth that we've been experiencing in the markets the last, call it 6 months, really just since Liberation Day, how much of that growth is directly attributable to one company making all of these big pronouncements, $1.4 trillion in spending expected. And so those comments have obviously been walked back over the weekend. They've tried to put it right, and investors seem to be a little bit more at ease now with what they're seeing from Sam Altman et al. I also think Michael Burry's short on Palantir, which is a widely held retail name. I think also NVIDIA is a widely held retail name. I think those two specifically rocked our confidence a little bit as investors, but I definitely think it had a lot more to do with that than it did with anything related to the government shutdown.
That seems reasonable to me, Tom, no?
I mean, yes and no. I'd say investors don't like stocks that go up a lot. They tend to get very nervous, and people want to take profits. But, do I think OpenAI is the only reason the S&P's gone up this year? I mean, that's a real bold proclamation. I mean,
I don't necessarily think that's exactly what Malcolm is suggesting.
No.
But when you have people from that company come out and they're talking about potential backstops and bailouts, it makes people wonder. When you have someone like Burry come out and talk about shorts on stocks like that, it makes people wonder. When Meta comes out and talks about the level of spending that they're doing during their earnings report, and people think about what the end game is, it makes you wonder. All those are real things that were at play.
Yeah, but Scott, just keep in mind a couple of things. One, there's been doubts on AI for the last 3 years. Every time there's a speed bump, someone points to a headline or a story and cites that exact fact, like, is the spending unrealistic? So I would say that that's a consensus statement I've heard time and again. On Michael Burry, he's a well-respected guy that does his homework, and so I do think people pay attention to it. But then again, his track record is not 100%. So I think he might be a sobering voice in the room.
Whose is, Tom? I mean, whose is? Yours isn't. I mean, mine isn't, and no one's is.
Yeah, but then we shouldn't treat his proclamations as if this is destiny. But I think he is raising good points that we should think about. But to tell me that that's the reason stocks go down, again, that's people attributing news to market moves. That's, I'm not sure I actually could answer that. I could say there's a million things affecting stocks, but to me, Does Michael Burry change Palantir's growth trajectory? Probably not. Is he making investors wonder if there is the right risk premium? Maybe. But again, markets will resolve that in the next few months.
But
go ahead, Malcolm.
Scott, if I may, very
Yes,
specifically, Palantir is up over 150% on the year, and it's widely held by retail investors. So anything out there that comes from someone with as big a name as we just agreed Michael Burry is, that spooks investors and shakes their confidence a little bit. And so the very first reaction is sell first and then ask questions later. I think we could make the same case for a number of the other names that are tangentially related at least to OpenAI, with these large spending commitments that their share prices have run up a tremendous amount based on promises made by OpenAI specifically. So the question of where are you going to get the revenue to justify the spend that you've committed to is a legitimate one. And for investors to say, I don't really like the answer from the CEO that I heard, so I'm going to shoot first and ask questions later, I think that that's reasonable to assume that that is what spooked confidence last week when you consider the NASDAQ fell almost 1,000 points, and it's the first time since Liberation Day that we've seen such a move. So tech moves the market. Tech is the market right now. I know that everyone's out there calling for this broadening trade right now, and it's just not happening, right? The equal weight S&P is at like 8% year to date. The cap-weighted S&P is up over 16% year to date. So you can fight tech if you want to, but you'll be one of those managers that Tom was just talking about that is underperforming the index. And so I think we have to call it what it is. Investors are looking for a reason to get spooked on AI, and last week gave it to them.
Kev, is tech going to be, is it going to remain the trade, the thing that matters the most for the remainder of the year? Are you one of these calling for the broadening in the market?
Well, I think what's funny, well, first of all, broadening of the market really just depends on whatever time frame you pick. So, I mean, if you look over the past 3 months, healthcare is the best performer. It's not tech. So it really is just a matter of perception.
But you know what we're talking about.
But I mean, I think that you can use that as an argument or to support the argument that actually there have been broader gains for the market. And that certainly showed up in earnings data that we've seen in the third quarter. So I'm not fully on board with the fact that the rally hasn't broadened out. I think that there have actually been positive aspects. The fact that you haven't seen, sub 50% so far in this post-Liberation Day rally for the percentage of companies that are above their 200-day moving average. I mean, you could go down the list of ways that the market has remained relatively resilient, relatively healthy. I think just the last thing on tech, there's so much focus on that being a top performer. For a good chunk of this year, it was not. Second of all, from an AI perspective, I mean, that theme is really starting to creep into basically every sector in the market. So I get a lot of the focus. I understand it, and a lot of the emphasis and concern over, single stock risk and maybe single sector risk. And it was certainly a big topic at our Impact Conference last week.
Well, I want to ask you about that.
But that I think is important to focus on.
How you think retail is feeling after the week that was? Based on, I talked a lot about the retail investor at your conference.
Yeah.
Because, I mean, you are who you are as Schwab. But, I mean, what do you think the psyche of the retail investor is right now?
The psyche is still, I would say, generally optimistic for the broader market. But tech has really been that main focus. And I was doing, even outside of Impact, I was doing client events last week in the Denver area looking at, what are the biggest concerns that people have with the market in particular in the U.S. Most of it is really just focused on the tech sector. There isn't a broader concern outside of that. So if anything, it was this desire and it was this question around how do I diversify outside of this but still stay invested broadly in the market. And I think that's sort of where we were and where we landed on in the general sentiment at Impact was concern over some of the circular financing and vendor financing that now exists. But again, there are ways to diversify out of that, and you can find yourself in a pretty healthy spot. Even year to date, utilities are still doing quite well. Communication services is doing quite well. Healthcare is now starting to pick back up. So if you were diversified across mostly all 11 sectors, then you've been sort of managing the hits relatively well, especially last week.
Yeah. All right, good stuff. Kevin, thank you. Malcolm, thanks. Tom, always thanks to you as well. We'll see all of you soon.